What if the biggest difference between an average investor and a billionaire investor isn't intelligence, insider access, or luck, but patience, discipline, and a few principles hiding in plain sight? Every market crash, every boom, every headline about sudden riches makes investing seem mysterious and unpredictable. Yet when you look closely at the world's wealthiest investors, a surprising pattern appears. Their success is not built on secret tips whispered in closed rooms, but on repeatable behaviors, long-term thinking, and a deep understanding of human psychology. Today, we're pulling back the curtain to reveal the hidden secrets behind the world's wealthiest investors, and how these lessons can reshape the way you think about money. The first major secret is that wealthy investors obsess over long-term compounding, not short-term wins. Warren Buffett, often cited as the most successful investor of all time, has repeatedly said that his fortune is the result of a long life, good genes, and compound interest. According to publicly available data, more than 90% of Buffett's net worth was accumulated after his 50th birthday. This wasn't because he suddenly became smarter later in life, but because decades of steady compounding finally began to snowball. Wealthy investors understand that time in the market matters far more than timing the market, and they structure their strategies to benefit from years, even decades, of growth. Another overlooked truth is that the richest investors are extremely selective. They do not chase every opportunity. Charlie Munger, Buffett's longtime partner, famously compared investing to waiting for the perfect pitch in baseball, except with no strikes. This mindset is supported by historical data. Many top-performing investors made the majority of their returns from a small number of exceptional investments. For example, a significant portion of Buffett's long-term performance came from just a handful of companies such as Coca-Cola, Apple, and American Express. The secret isn't constant action. It's disciplined inaction until the odds are strongly in their favor. A third hidden principle is a relentless focus on risk management rather than returns. Wealthy investors think first about how much they can lose, not how much they can gain. Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds, has emphasized risk parity and diversification as core principles. Dalio's research into historical market cycles showed that protecting against large drawdowns is critical to long-term survival. Losing 50% of capital requires a 100% gain just to break even. The richest investors design portfolios to avoid catastrophic losses, knowing that survival is the foundation of success. Closely tied to risk management is the idea that volatility is not the same as risk. Many inexperienced investors panic during market downturns, but wealthy investors often see volatility as opportunity. During the 2008 global financial crisis, markets collapsed, and fear dominated headlines. Yet investors like Buffett deployed billions of dollars into companies such as Goldman Sachs and General Electric at favorable terms. Public records show that these investments later produced substantial returns. The hidden secret here is emotional control. Wealthy investors train themselves to remain rational when others are fearful. Another powerful but rarely discussed secret is simplicity. Despite the complexity often associated with finance, many top investors favor simple, understandable businesses. Buffett's investment philosophy is famously centered on buying companies he can understand, with clear business models and durable competitive advantages. Academic studies on factor investing and long-term market returns support this approach, showing that companies with strong fundamentals and consistent profitability tend to outperform over long periods. The wealthy are not impressed by complexity. They value clarity. A critical psychological edge among wealthy investors is their understanding of behavioral biases. Nobel Prize-winning research in behavioral economics has shown that humans are prone to fear, overconfidence, and herd behavior. Wealthy investors actively work to counter these instincts. George Soros, known for his macroeconomic investing, has spoken openly about the importance of recognizing when emotions interfere with judgment. His success, including his famous 1992 bet against the British pound, was rooted in disciplined analysis rather than emotional reaction. The secret is not eliminating emotion, but preventing it from controlling decisions. One of the most misunderstood secrets is that wealthy investors are constant learners. They read extensively, study history, and analyze past failures as much as successes. Buffett has stated in interviews that he spends the majority of his day reading financial reports, books, and newspapers. This habit is not unique to him. Many top investors credit their edge to a deep understanding of economic history, allowing them to recognize patterns and avoid repeating past mistakes. Data from market cycles over the last century consistently shows that while technology changes, human behavior remains remarkably consistent. Another hidden principle is alignment with strong incentives. Wealthy investors pay close attention to management quality and incentive structures. Research in corporate governance shows that companies where executives have significant ownership stakes tend to perform better over time. This is one reason why investors like Buffett prefer businesses where management's interests align with shareholders. The secret here is understanding that numbers alone don't drive results. People do. The world's wealthiest investors also understand the power of pricing versus value. Price is what you pay. Value is what you get. This distinction, popularized by Benjamin Graham and carried forward by value investors, is supported by decades of market data. Studies on valuation metrics such as price-to-earnings ratios have shown that buying assets below their intrinsic value improves long-term return potential. Wealthy investors spend far more time estimating value than predicting short-term price movements. Another rarely acknowledged secret is the willingness to look wrong in the short term. Many wealthy investors endure years of underperformance while sticking to their convictions. For example, value investing strategies underperformed growth stocks for much of the 2010s, yet long-term historical data still supports the effectiveness of valuation discipline over full market cycles. The hidden edge is emotional resilience, the ability to stay the course when results lag and criticism is loud. Wealthy investors also benefit from a deep understanding of macro trends, not as prediction tools, but as context. Investors like Ray Dalio study debt cycles, interest rates, and monetary policy to understand the environment in which assets operate. Historical data from central banks and financial markets shows that shifts in interest rate policy have long-lasting effects on asset prices. The secret is not forecasting exact outcomes, but positioning portfolios to be resilient across different economic scenarios. Another critical yet subtle secret is capital allocation discipline. Wealthy investors constantly reassess where their capital can earn the best risk-adjusted return. This includes knowing when to sell. Contrary to popular belief, top investors do sell, but usually when fundamentals change, not because of short-term price movements. Data on long-term portfolio performance shows that disciplined reallocation, rather than emotional trading, contributes significantly to sustained wealth growth. A powerful but often ignored factor is tax efficiency. Many wealthy investors structure their investments to minimize unnecessary tax drag. While tax strategies vary by jurisdiction, the principle is universal. Taxes reduce compounding. Studies on after-tax returns show that long-term holding periods and tax-aware strategies can significantly increase net wealth over decades. This is not about avoidance, but optimization within legal frameworks. The final hidden secret is perhaps the most important. Consistency beats brilliance. The world's wealthiest investors are not perfect. They make mistakes, experience losses, and face uncertainty like everyone else. What sets them apart is the consistent application of sound principles over long periods. Data on investment performance repeatedly shows that steady, disciplined strategies outperform sporadic bursts of genius. Wealth is built quietly, not dramatically. When you strip away the myths, the hidden secrets behind the world's wealthiest investors are surprisingly human. They manage risk before chasing reward, think long-term in a short-term world, and master their emotions in moments of fear and greed. They rely on data, history, and discipline, not hype. These principles are not reserved for billionaires. They are available to anyone willing to adopt them. If this breakdown helped you see investing in a new way, and you want more deep, data-driven insights into money, markets, and wealth-building strategies, make sure you subscribe to the channel. Hit the subscribe button, stay consistent, and join us as we uncover the real principles that shape financial success, one episode at a time.